A warm welcome back to all of you to another live session at Wide-Moat Investing Summit 2016. Truly a pleasure to welcome back to Value Conferences returning instructors John Heldman and David Hutchison, partners and portfolio managers of Triad Investment Management. They're joining us from Newport Beach, California. John brings nearly 30 years of experience to the management of investment portfolios. Prior to founding Triad, he was a senior vice president and portfolio manager with Neuberger Berman. He also managed investment portfolios for Deutsche Bank, Scudder, and Bank of America. And David has more than 2 decades of experience as well. Previously, he was investment strategist for Chamberlain Group, directing investment manager research. He also founded and managed Hutchison Capital, a registered investment advisor. It's been a true pleasure for us and our participants to learn from John and Dave in the past. We've enjoyed their ideas and the work that goes into them, and we look forward to the Wide-Moat idea that they have in store for us today. Just a reminder, if you have questions during the presentation, feel free to type them into the online interface at any time, and we'll try to get to them during the Q&A session. And with that, John and Dave, I'd like to turn it over to you. Please go ahead.
All right, this is John. I'll get started. Good morning or good afternoon, as the case may be, to all of the participants, and welcome to our presentation. We are going to be talking today about Sotheby's, a company that we think has a very nice moat, and we hope to show you some of the aspects of what we think make the company attractive. Looking at our first slide, this is a painting that probably many of you have seen before. It's Edvard Munch's painting entitled "The Scream," and no, it wasn't fashioned after a stock market investor. Although, given the gyrations in the stock market lately, you could be forgiven for thinking that that was perhaps the inspiration. This painting sold for almost $120 million in 2012. None other than Leon Black of Apollo Global paid the princely sum for this particular painting. And I'm guessing that if Mr. Munch were alive, he might be a little surprised at how much this particular painting has sold for. Moving on to the next slide. This is Andy Warhol, very popular artist, also no longer with us. This is his painting or artwork entitled $201 Bills. This one sold for almost $44 million in 2009, and this had previously sold prior to 2009. It last sold a little over 20 years before that, and it sold for about $300,000. So from $300,000 to $44 million over a roughly 20-year plus period. So you can see the art world doesn't seem to conform to some of the standard notions that we might think of in terms of value. And then the last piece we wanted to show you is one of my personal interests is the Rothkos, Mark Rothko, who this is sort of his signature work. It reminds me of something that I might have done in kindergarten. This particular work went for over $46 million in 2015, and many of Rothko's works have this particular style to them. I'm not myself a big fan of contemporary art, so it's hard for me to maybe dig into my wallet and pay $46 million for something like this. But many Rothkos have sold for many, many millions of dollars. And again, if he were with us, I think he'd be shocked at the prices that are being paid for some of his artwork. So the art world, as I'm sure many of you who just in general reading see, it's subject to the booms and busts, just as we see in the general economy and the stock market. And it's had a little bit of a boom here over the last number of years. And so it's something that we certainly think about when we think about the companies. But the art world doesn't. It's really in a world all its own. So we just want to give you a little flavor for the types of art that's out there, and what people are paying for these. In many cases, people are doing it based on analysis and thinking that this is a good investment. So it is a good investment as long as people continue to pay the prices for these artworks. So it remains to be seen, how that continues to unfold as the years go by. So with that introduction, let me turn it over to Dave to discuss specifically our thinking on Sotheby's and the business of Sotheby's.
Great. Thank you, John. Yeah, I think that was a great overview of some of the pieces, and as you might have guessed, all three of those pieces were auctioned off by Sotheby's over the last several years. But let's take a step back here. First of all, the overall art market and the market that Sotheby's concentrates in are slightly different animals. The overall art market is fairly fragmented. It's over $60 billion of transaction value, roughly split about half and half between public auctions and private sales. About 40,000 points of sale, as you might call them, in the art world, mostly art dealers, but also galleries, auction houses like Sotheby's. 39 million transactions, over average transaction size in art is only a little over $1,000. But the high-end market that Sotheby's focuses in on is much different. They're essentially a duopoly and share that market with their very close competitor, Christie's. Over $12 billion last year of high-end art sales, roughly half and half going to those two companies, but more to Christie's, 52% versus 48% for Sotheby's. Christie's, just to give you some background, is a 250-year-old company, just slightly younger than Sotheby's itself, privately held, owned by Group Artemis, which is the holding company of billionaire Francois Pinault, and they're known for their strength in contemporary art, which has been particularly strong in the last several years. The next slide, just to give you some extra insight, is an analysis of the global art market, and you can see the lion's share of it last year went to the U.S., U.K., and China. In fact, that adds up to about 83% of the market, and those are markets in which Sotheby's and Christie's are all strong and have auction houses, and that's where many of the bidders are as well. And that will turn more to Sotheby's itself. BID is its ticker. Founded in 1744, Sotheby's is the oldest company listed on the New York Stock Exchange, and is the only publicly traded art market company. It has a worldwide presence, as you can see on this slide, over 90 locations in 40 countries, as well as 9 auction sale rooms, with the largest being in the U.S., in New York City, and in London. It's a fairly, overall, the business is a lean, efficient business model with low capital expenditure requirements, obviously low inventories, and a very variable expense structure that depends on the success of the auctions. However, it's a lumpy business. Major pieces only come up from time to time, and it's also seasonal in that the second quarter and fourth quarter historically have been bigger quarters than average, and have more sales in them. So it's not a smooth, easy to predict business in terms of sales growth. Sotheby's has 3 main segments that we'll get into: agency, finance, and brand licensing, and other is what I'll call the last one. Agency is the primary business, and it's the primary revenue and profits driver. Sotheby's accepts property on consignment, stimulates buyer interest through extensive marketing efforts, including catalogs, spending to reach its network of bidders. And it essentially, of course, matches sellers, which are known as consignors in this business, to buyers in either auctions or private sales, with the majority of their business being in auctions. They host about 250 auctions each year. Had a fairly large one last night, across 70 different categories. And their business model is that they earn both a buyer's premium, which is typically 12 to 20% of the hammer price, or price that the final price of the item that's sold at auction, as well as a seller's commission, which is deducted from the proceeds that the consignor ends up receiving from Sotheby's. And these buyer's premiums tend to be lower or sometimes non-existent on very large sales. In particular, also in recent years, and this has been a bit of a problem for both Christie's and Sotheby's, Sotheby's both of them will offer minimum sale prices to consignors to entice them to select their form versus another's. And that can present a risk to Sotheby's, obviously, if the item either doesn't sell or sells below the minimum stated price, and then Sotheby's is responsible for the difference. To offset this risk, they've enlisted counterparties, often major dealers or collectors, that in exchange for taking on some of the downside risk are able to take on some of the upside risk if the property were to go above the expected amounts. And that helps offset some of the risk that they take on in minimum sale guarantees. They also have an online platform called Bid Now, in which clients can view all Sotheby's auctions online and also place real-time bids. Private sales are a smaller part of their business, as I mentioned, and Sotheby's earns either a fixed amount or a commission rate on those sales. The attractiveness of private sales, which are a big part of the market, is that they offer consignors privacy from the public. They offer a quicker sale. Instead of having to wait for the next appropriate auction, they can do something much sooner. And then it also allows the consignor to test out an aspirational price for an item without, kind of getting that in the public view. The next segment I will talk about is finance. It's unique in that it's a lending business, and many banks won't lend based on the value of artwork, but Sotheby's will based on its appraisals and expertise and the fact that it helps their business, frankly. And they do this in two different ways. They either provide essentially an advance to a consignor who's contractually agreed to sell that item at Sotheby's, either via auction or private sale, or it can just be a term loan for an art collector that wants to get a loan and have it backed by his or her artwork. The revenue margin of this segment was 8.9% in 2015, and it's been rising somewhat in recent years. The portfolio is of generally high quality, has approximately a 50% loan to value currently. Prior to 2014, they changed the capital structure behind it a little bit. Before 2014, Sotheby's used operating cash flows to support this business, and now they have a dedicated revolver to help fund the finance business, backed by the artwork, of course. And then finally, a small piece of Sotheby's, but it's worth mentioning, is the brand licensing piece. Prior to 2004, Sotheby's owned Sotheby's International Realty, which was a real estate agent focused on luxury real estate sales. They sold that to Realogy, and then Realogy turned around and licensed that trademark and the ability to use basically the Sotheby's name for 50 years. And they pay a percentage of their top line to Sotheby's as a royalty, a license fee, and that's generally range from $6 to $8 million per year. And then also included in the segment is their 25% investment in RM Sotheby's, which is a investment-grade auto auction. Now let's turn to the moat. What makes Sotheby's worthy of being discussed along with other companies with moats? And there's, as you've heard in this conference, there are many ways companies can develop and maintain and grow a moat. We think Sotheby's has evidence of a moat in two main areas: the network effect and their brand. Over 250 years of history, Sotheby's has established a position in the high-end art market with a very large base of bidders, both new as they continue to grow, but also people that have bid in the past, and long-standing relationships with consignors, collectors, art dealers worldwide, and also just so it's a large network in an auction business. You want the the widest possible market to get the best possible price, and it's something that Sotheby's and Christie's can offer to an owner of a very fine piece of art. And it would be difficult for a new entrant to replicate this in the short run. And secondly, the brand, the Sotheby's brand is well known. As we've seen, it's been licensed in other areas, but it's primarily known for auctions and has appeared in media, and movies, various formats, and has been around for so long. It's very well known. It's a prestigious luxury brand, synonymous with the high end of things. It also provides, since this is a marketplace, it provides buyers and sellers with a little bit of confidence. It's one of Sotheby's functions is to authenticate the auction items, and it helps provide them with the confidence that they are dealing with a long-standing, well-known organization in that process, and obviously entrusting a very expensive item to their care. Also would be difficult for a new entrant to develop as meaningful a brand. We've seen, over, literally centuries, these two companies have dominated the market, and other companies such as Phillips have attempted to enter and become a bigger part of the market. They're certainly a part of it, but they have not been able to join Christie's and Sotheby's in the top end of sales. In the last several years, though, the business has experienced a few problems and issues, and some of which have been already dealt with, but it's worth discussing. Probably the biggest issue is I would say, excessive competition they've experienced with Christie's since the downturn of the economy in 2008-2009. Both Christie's and Sotheby's have been excessively competing for the very highest end pieces, and in many cases reducing their commissions, making very little on the sale of some very large high net worth pieces, high worth pieces. In their effort to gain market share and publicity, and the sale of those very high-end items, even if it's not profitable, helps attract and bring in other items, not only on the high end, but in the middle market, as we'll discuss later. So there is some strategy to it, but it's also been detrimental to margins. Decreasing share in the private sale market, about 6% of overall sales are in private sales, but that's about, as we saw in the overall market, is about half of the sales are in private sales settings, including dealers. So that's an area that has been a weak spot for Sotheby's. They have been somewhat relatively weak, I would say, in contemporary art. They lost the head of the contemporary art department, Tobias Meyer, in 2013. He was also regarded as the face of Sotheby's in a way, so that was a loss. Christie's has performed better in contemporary art, but that's been a weak spot. And then overall, the capital management of the company, especially several years ago, was poor. They had a large cash balance, excessive loan receivables. Art inventories were high, as they were either took pieces on a principal basis or were required to based on minimum guarantees. And then real estate, they owned very expensive properties. They continue to own very expensive properties in New York and London in particular. And there were some issues about whether or not that capital would be better redeployed elsewhere. Some of these issues, and this is probably going back to 2000, the early 2000s, have been addressed. Starting in mid-2013, activist investors, Third Point and Marketo, became involved in taking on shares of the company. Now they own together about 11% each, or 22% combined, of Sotheby's. Third Point's probably been the more activist. They were led by Daniel Loeb, and Daniel initiated a proxy contest, and his issues with the company's management were that they had relatively lower revenue and earnings in 2013 than they did in 2007, despite a similar level of auction and private sales. Directors at the time had low ownership stakes. Compensation of the executives was relatively high, not only based on the company's performance, but also, in his view, based on the size of the company, more in line with a much larger firm. And he sought the ouster of Bill Ruprecht, who was the CEO at the time, and also felt that there was a lack of overall strategy and vision for growing Sotheby's at the time. He ended up prevailing and getting 3 control board seats on Sotheby's board, including one that he held himself. And also, his efforts led to Sotheby's getting a new CEO, Tad Smith, who joined in 2015. He's the former CEO of Madison Square Garden, and has a media and entertainment background, and also teaches at a business school. I think he brings in and does not have, which is important to note, extensive experience in the art world. So he's bringing an outsider's viewpoint, which was probably a good idea at the time, and I think a good idea today. He's identified his 4 main priorities as developing a compelling strategy for Sotheby's, applying technology and innovation to the business, improving capital allocation, which we've seen as an issue, and also developing an organization and processes that can support those other 3 initiatives. They also were able to add a new CFO, Michael Goss, and he joined this year, further bolstering their team. The capital allocation of the company, I would say, has been improved. They cut their 40-cent per year dividend earlier this year to focus on buybacks, and they did so with gusto. They bought back 6% of the company in January and have a continuing authorization, I think, of about $139 to do additional buybacks, which they have clearly stated they plan to use. And they also refinanced their Manhattan property, which has saved them over $100 million a year. A step they still could do would be to do a sale leaseback of their New York and London properties, which could generate even additional value for shareholders. Turning to growth potential, there's a few areas where Sotheby's has identified a focus, and I think are and will be able to prosper from focusing these areas. The first is the middle market. Overall, worldwide, the high net worth market has been growing rapidly and is relatively lightly exposed to art collecting. The European Fine Art Foundation notes that about 600,000 of 32 million millionaires worldwide are mid to high level art collectors. So that represents 4 to 5% of penetration rate, relatively low number. The middle market, which is generally sales between 250,000 and $1 million, just to give you a perspective. So still very nice pieces of art, but lower than the pieces that John identified at the beginning of our presentation. The sales for this segment, the margins are better. There's less competition for those pieces, and there's less likelihood that either Christie's or Sotheby's will cut commissions significantly to win them. And they benefit from the strong brand and image of Sotheby's in this marketplace. And we've seen them on advertising online to reach the middle market and appeal to them that way as well. Tad Smith has been pushing it. He says he wants to be, and I quote, Sotheby's to be a little bit more affordable and friendly to the middle market. So that's one way they can grow. And another way is to increase their presence in the private sale market. They've been losing share. They can at least have a share that's more representative of the market as a whole. And one of their initiatives, which I'll talk about later on this slide, art agency partners, might help them in that regard. Rational CEOs leading to better profits, and CEOs is plural because it's the CEOs of both Sotheby's and competitor Christie's from what we can tell, are both acting more rationally than their predecessors have in the past. Less of a focus on gaining market share at all expenses, and a little bit more concerned about the bottom line. Christie's new CEO, for example, joined right about the time Tad Smith did in early 2015, Patricia Barbizet. She's seen as a finance-minded, shrewd CEO, which, even though Christie's is private, has the potential to lead to a little bit more rational behavior from them. She replaced Stephen Murphy, who was had only been in the job a few years, but who had been seen as having been someone that focused more on gaining market share at the expense of profits. So that's a sign from Christie's owners that they might be more concerned about profits. And then finally, Sotheby's recently bought for about $50 million plus an earnout Art Agency Partners, which is a firm that will help them focus more on developing relationships with consignors versus only being a transactional company, and helps them grow their private sale and contemporary side. They were acquired this year. It's led by Alan Schwartzman, who is a founding staff member of the new Museum of Contemporary Art, and Amy Cavazello, who has formerly worked at Christie's. They've developed the Sotheby's Fine Art Division, which is a combination of the Impressionist, Modern, and Contemporary departments led by these individuals, with the effort of growing, obviously, their focus on contemporary, and they think they'll also be able to develop a revenue stream from this business where they basically provide advice to art owners as they seek to develop their collection and advise them how they can best do that. So in summary, if you look at it, some of the problems that we've identified have been fixed, but and we'll get to later, we don't think they've been reflected in the price as the share price has declined despite the partial repair job that's gone on. The risks in the business are these. Primarily, the competitiveness with Christie's is always present and could. There's no evidence that it will. There's no guarantee that it will abate with this, even with the new CEOs at the wheel. Christie's is privately held. That's often mentioned. It gives them a little bit more freedom to run their business for the long run and be a little bit more concerned with short-term profitability or what Wall Street thinks, which is an advantage in this business. It's a people and relationship business. Is the value that Sotheby's has in the name Sotheby's and the firm, or is it in the people that work there, and as those people move to different firms and bring customers, have the customers follow them, is that where the value is going? That's something we've looked into and wondered. For example, Alex Rotter, the co-chair of Contemporary Art, moved to Christie's this year, so that's one risk. And then finally, seller power. I think in this business, there's a limited number of pieces. It's uncertain as to when or if they'll ever be up for sale. And so that will always lead to the tendency for Sotheby's and Christie's to over-compete to win those pieces. And now, in terms of, as we mentioned, we think the current market price versus the value, there's a little bit of a disparity, to say the least. I'll turn to John now to discuss the valuation of the company.
Thanks, Dave. All right, so we put together a simple chart here that just shows how we think about the valuation of Sotheby's. So we generally have a 3 to 5 year time frame. So we take the midpoint of that basically, which brings us out to 2020. So on the top line, we're looking at sales this year, revenues of about $830 million. We assume that the revenue grows at around 6% per year, which we think is in line with historical growth rates. We do like the new CEO, and as Dave mentioned, he has a financial background. We think there's some opportunities to improve margins, specifically on the cost front especially. Also, they have been giving away a lot of the margin on the auction margin because of the competition with Christie's, and we think that the competitive intensity is likely to lessen a little bit, and so a combination of a little bit better auction margins along with some cost reduction on the back office will allow margins to expand slightly. So whereas this year we think their EBITDA margins are going to be around 27%, we think they can expand slightly to about 31% looking out over our time horizon. And that's not unusual. They've actually had, in previous years, they've had even higher margins than that. So we think that it's relatively realistic. And it's a very capital-light business. There's not a lot of capital spending, so the EBIT margins are very close to the EBITDA margins. We are assuming an EBITDA multiple of about 12 times. We think for a world-class brand such as this with what we think are strong moat characteristics that are likely to endure, the multiple strikes us as reasonable. We look at a lot of other businesses and look at the multiples that they sell for. We also look at just about any acquisition that happens in the public marketplace and look at those companies on multiples of EBITDA and EBIT and other measures to try and get a sense for the acquisition prices that buyers are willing to pay for companies. And we don't think that this is really a stretch at all. And then we we look at some of the hidden assets that the company has. Company has a lot of cash on its balance sheet currently. It also has some art inventory that is earning nothing and can be can be sold and turned into cash. And it also has a real estate. Has a property in New York City, which could be sold for, we think, about perhaps $500 million. The London property is also doesn't have a mortgage on it. That's probably less likely that they would do a sale leaseback there. But we think there's a fair amount of assets that really aren't earning their keep, and we think the balance sheet can be managed a bit more aggressively by the new management team compared to the old management team. And actually, we are seeing that the new management team is taking steps to realize some of the value of some of these assets that have been kind of not earning their keep, particularly the share buyback, which they've already bought back shares. They are doing more, and as a percent of the market value of the company, it's a fairly significant amount. So we do think there's more to be realized there. So the company has some debt. Some of the debt is that you see on the balance sheet is used to finance the loan business. So we don't necessarily attribute that to Sotheby's. We think that should be attributed directly to the loan business. So we exclude that debt. So we also think that the company's already made some share buybacks. The company has currently about 58 million shares outstanding. We think over time, with the free cash flow that the company will generate over the next 4 years, along with some of the current cash reserves and cash that's likely to be raised through asset sales, that the company will make a meaningful dent in the share count. And we're thinking that the share count can go from about 58 million today down to around 45 million. And when we put this all together, that gives us an indicated value of much higher than today's stock price by quite a bit. So we think these assumptions are reasonable. Even if we were to reduce the EBITDA multiple, we still think that there's meaningful upside for the share price based on today's price. So so that's just a little bit about how we view the company in terms of the current valuation and what we think could happen over the next 3 to 5 years. So with that, I think that kind of wraps up our presentation. We like the company. We think it's been somewhat undermanaged. Clearly, the activists who are involved with the company and on the board certainly feel that, and we think that there's a lot of internal or self-help that the company can do that even in an environment where the art market isn't as robust over the next 3 to 5 years as it has been over the last 3 to 5 years, we still think there's a lot of things that the company can do internally that can help to even strengthen the moat and provide some decent prospects for shareholder return. So with that, we'll kind of wrap it up and take any questions.
Well, thank you very much, John and Dave, for the idea and the presentation. Just a reminder to everyone, if you have a question, feel free to type it into the online interface. I'll just get started on the queue right now. Normalized cash flow has been about 125 million over the last decade. What are your assumptions for cash flow going forward?
We are expecting that that with the profit improvements that we think are likely to happen over the next 3 to 5 years, in terms of free cash flow, we're anticipating about 150 million per year in free cash flow on average over the next 4 years. So that's going to ramp up in the out years, but we think it'll average about 150 million per year.
Next question, can you please talk about cyclicality in the business? If we assume for the sake of argument that extraordinarily low interest rates have inflated asset prices to peak levels, how does that impact the thesis?
Yeah, certainly the art market, just as many other markets, is a cyclical market, and it is subject to the ups and downs, and it's certainly had more ups over the last 3 to 5 years. So you would assume that there should be some cooling off of the market, and we think that's perfectly reasonable, and that's actually, we think, why you've seen the stock price of Sotheby's actually come down a fair amount here over the last year or so. So we think that while there is that possibility, it's difficult, just as it's difficult to know what the stock market is going to do over the next couple of years. We think it's difficult to know what the art market's going to do. It kind of behaves in its own way, but it's certainly cyclical, and we could have a period where there isn't much, in terms of top-line growth, and we're prepared for that. We think the company has enough, again, internally, things that it can do to offset some of that cyclicality, that even in a more subdued environment, we think as shareholders will do just fine.
Can you provide a little more color on the activist involvement? You obviously talked about the main activists and when they came in. Are they still as active, and what do you think their end game is?
Well, Dan Loeb is on the board currently. He's part of the executive committee. So we haven't had any conversation with him, but the fact that he's on the board, Third Point owns 10%. We think that we certainly think that their interests are aligned with shareholders, since they're one of the largest shareholders, and we think that it's going to take some time. It's not going to happen right away, but we think they know what needs to be done. There's a number of different levers that the company can pull to improve its results, and a lot of it is not really dependent on a robust art market. It's just dependent on managing the business a little bit better, whether it's on the income statement, managing costs and expenses better, or if it's on the balance sheet. We think there's a number of things that can be done on the balance sheet, and they are aware of all those things, and they've pointed them out, and we think that they're going to continue to make their presence felt on the board, and over time, we think that the rational things that need to be done will be done now that we have a more rational, we think, management and board in place compared to the prior management.
I'd like to now go to the line of Shai Dardashti for additional questions, please. Shai?
I have a question similar to the previous comment about interest rates. I'm wondering to what degree currency movement from Russia and China into North America might be a factor worth adjusting for.
In terms of?
Again, I'm concerned that perhaps there's been money flow leaving Russia, leaving China, using the art market as a way to get the money out, and if that's an appropriate risk.
Well, I mean, certainly China's been a big participant in the art market over the last number of years, and to the extent that China has been cooling off over the last few years, and you've had this crackdown on corruption and gift giving. That certainly doesn't add a positive aspect to the art market. So anything could happen. Those are economies that we certainly can't predict what's going to happen. We guessed wrong on Brexit, so there's a lot of things that that we don't know for sure how those things are going to play out. But we think that the business is sound enough; it certainly can deal with whatever happens coming out of Russia or China. The art market is long established. Despite what may be going on in those particular countries, we think that the art market's going to be fine. There may be some short-term repercussions, but again, we think that the company has enough internal levers to pull that even in an environment where the auction results are a little bit weak, we think that some of the low-hanging fruit can be harvested, and as shareholders, we think we'll be fine over the next couple of years.
And I'd like to turn to slide 13, the estimated valuation table. It looks like the EV to EBITDA multiple at the moment is around 4. The target multiple is about 12, and that's basically a three-bagger in the stock and a three-bagger in the multiple. I'd like to understand more how you have a 12 times target and why 12 and not 15.
Yeah, the 4 is an imputed multiple based on real estate and some other assets that the company is not currently getting credit for. So if you actually look at the multiple just in terms of EBITDA today, it's more like, I don't have the numbers in front of me, but it's probably more like 8 or 9 times EBITDA. In other words, we're including all the other assets that we think have value. So effectively, if you were buying the company today, if you assign the values that we assign to the other assets, you're effectively buying the company for about 4 times EBITDA. In terms of what we think the multiple could be over time, we don't think 12 times is out of the question. Should it be 15 times? I suppose if somebody wanted to acquire Sotheby's, you could make an argument that they might need to pay 15 times. Most of the acquisition multiples that we see for this quality of business have tended to be in the broadly in the 10 to 14 times EBITDA. There are companies that have where acquirers have paid more. Sometimes it's because, again, today interest rates are very low. It's very easy to borrow money. So that has an impact. The business cycle has an impact as well. When times are good, people tend to pay more, pay higher multiples for companies. But based on our analysis of many hundreds of acquisitions of businesses of all flavors of quality, growth rates, 12 times EBITDA, we don't think is too aggressive. And also, it's a very low capital intensity business, and generally, those types of businesses tend to sell for higher multiples than a heavily capital intensive business such as the steel business or the automobile business, where the multiples tend to be 4 to 6 times EBITDA, as an example.
John, back to you, please.
Thank you, Shai. If you could talk to us a little bit about the structure of the market going forward. Obviously, you made a nice argument for the 2 main players getting more rational going forward, given their managements. What about longer term? Do you see any threats from alternative ways of getting the art sold?
Yeah, I think it's always a threat as things evolve, especially, I'd say, the the dynamic there might be the virtual or online space, an area that Third Point rightly identified as a weak spot in Sotheby's current lineup, and I think one that they're attempting to address. I think Christie's has been a little bit more active on the online side. Sotheby's has had some fits and starts with working with eBay in the past and other venues, and I think that's going to be an increasingly important thing as it gives you, we've seen in other auction-related businesses, it expands your network of buyers and sellers very easily without needing to travel to New York or London or other auction sale houses. So that as the market evolves that direction, they'll have to be able to keep pace there, and that's definitely something to keep an eye on. I do think, though, as we've seen, very few businesses can we point to two businesses over 2 centuries that have kind of dominated so thoroughly as in the high-end art space as Sotheby's and Christie's.
Yeah, and we think that it's their lead to lose. So if they fall asleep, then clearly there could be some online competitors that surprise them with growing that business and becoming stronger competitors. But we think now with the new management team that they're aware of the threat or the opportunity for new avenues such as online. So we don't think that they're going to be asleep at the wheel. We think they're going to go after those opportunities. The brand and the reputation, the expertise, we think all of those things in an online world, those things are meaningful. And if you're a bidder, even if you're not paying the ridiculous prices that people pay for some of the high-profile art, if you're an online bidder and you're going to bid $5,000, $10,000 or $20,000, $50,000, whatever it may be for a piece of art, for a lot of collectors that's a meaningful amount, and they're going to want the assurance, we think, of a brand like Sotheby's or even Christie's, as opposed to some of the other smaller players where you may not feel as comfortable that you're really getting an authentic piece. So we think that is an important aspect.
A question on the moat itself, and maybe drawing a parallel in the credit ratings market. It's sometimes stipulated that there has to be an S&P and Moody's rating. Is there something of that sort here with inheritance of art, where maybe in a will it's sometimes stipulated that it has to be auctioned by one of the major two?
I'm not aware of that.
I haven't seen that in anything we've come across. I could certainly see some individuals specifying that.
Right. Okay. All right. Well, we will leave it there, John and Dave. Thank you very much for the in-depth presentation and for the idea. Truly appreciate all the work that went into it, and also the detail on how you see the valuation. That's very helpful.
Okay. Well, great. Thanks for allowing us to participate. We've enjoyed it.
Yeah. Thank you.